What is an option? The term option refers to a financial instrument that is based on the value of underlying securities such as stocks, indexes, and exchange-traded funds, ETFs. Options contract offers the buyer the opportunity to buy or sell, depending on the type of contract they hold, the underlying asset. Unlike futures, the holder is not required to buy or sell the asset if they decide against it. Call options allow the holder to buy the asset at a stated price within a specific time frame. Put options allow the holder to sell the asset at a stated price within a specific time frame. Options contracts usually represent 100 shares of the underlying security. The buyer pays a premium fee for each contract. For example, if an option has a premium of 35 cents per contract, buying one option costs $35. 35 cents times 100 equals $35. Underlying, the security upon which the option is based. At the money, ATM, an option whose strike price is exactly that of where the underlying is trading. ATM options have a delta of 0.50. In the money, ITM, an option with intrinsic value, and a delta greater than 0.50. For a call, the strike price of an ITM option will be below the current price of the underlying. For a put, above the current price. Out of the money, OTM, an option with only extrinsic, time, value and a delta are less than 0.50. For a call, the strike price of an OTM option will be above the current price of the underlying. For a put, below the current price. Strike price, the price at which you can buy or sell the underlying, also known as the exercise price. Exercise, when an options contract owner exercises the right to buy or sell at the strike price. The seller is then said to be assigned. Expiration, the date at which the options contract expires, or ceases to exist. OTM options will expire worthless. Have a blessed trading day.